Hey, how's everybody doing? All right, this is kind of a unique situation, folks at home. We are on lecture number 27. And what happened is I have been taping these videos for 10, 11 years. And when we taped lecture 27, we had something that had never happened before. I was really sick that day. And I came, me being the dedicated teacher that I am, I came to class and tried to gut my way through taping lecture number 27. But it just wasn't very good. There were some things I forgot that were really important. My throat was scratchy. It was a disaster. Some of you were witness to that, and I apologize. So what we are going to do, folks at home, I'm doing this little quick introduction, and it should have had the same music and everything so that you know you're watching the right lecture. But we are going to switch over now here in about a half a minute, and you're actually going to watch lecture 27 that I taped a couple years ago with a different set of students, okay? Now, everything is the same. The homework problems are the same. The numbering is the same. There is zero difference. But you will see a different group of students here in about a minute. So I don't want you to think you're on the wrong sequence of lectures. You're in the right sequence, but that's why we're going to handle it that way. So if you have any questions or something, certainly email me and I can answer it for you. But I think it should be self-explanatory. So they're going to switch it right now over to that other class so that you can have a healthy and aware teacher teach you lecture 27. Hello everybody, how you doing? Good, good, good. We talked about, just to kind of bring us back to where we were, this chapter 8 is on internal controls and cache, right? And we talk about cache in the same chapter as internal control because it's one of the assets that you want to have the strongest internal control systems in place because it's very important to running your business, it's susceptible to theft, those sort of things, okay? Internal control, again, it's not all about just catching thieves. A lot of it is just promoting efficiency in your operations, catching mistakes and those sort of things, but that's what we've been talking about. We talked last time about some rules of effective cash management, and one of them is when at all possible, make your cash disbursements using a check, right? Because then you have a written source document, and when you write checks, you want to have the different vouchers behind them, the proof or the authorizations for that disbursement, such as a purchase order that's approved, a receiving report, and an invoice, all that stuff stapled together on the back of it. Now, the exception we talked about was petty cash, right? When there's a situation where somebody needs to purchase something very quickly, right? So we kind of talked about how there we need to kind of make an exception, okay? So let's talk about that. Let's go ahead and take a look at Quick Study 8.4. I'm not going to read it to you. Usually I read these to you, but some of these are so long, so I'm not going to read it to you. But for those at home, if you don't have a textbook, this is the one we're going to go over. Quick Study 8.4, okay? All right, let's go ahead and solve that. Okay. Okay, the first thing that we do is we set up the petty cash fund, right? And so the journal entry is we debit petty cash and credit cash for how much did we set this fund up for? $150. Okay? So that's to set up the fund. Cool? Now, let's do the journal entry to reimburse or to replenish the petty cash, okay? Now, when we open the box, how much cash is in there? $28. How much? $28. Okay, good. So the first thing I always do in this replenishment entry is how much more cash do I need to put in there to bring it up to the original level?
132.
I think you're close. 122, right? That's all right. 122. Okay. So that's the first step. How much cash do you need to put in there to bring it back up? Second step is picture yourself going through those invoices and booking them to the appropriate, usually expense accounts, okay? So I think we have entertainment expense. Is that correct?
Yeah.
For how much?
70.
For 70. Then I think we have some postage expense for 30, was it? And then I think we had some printing expense. And if you used, slightly different expense accounts, verbiage, that's fine. Okay, so it makes sense. Printing expense 22. So this was the first step. This is the second step. Now the third and final step is to ask yourself, does that journal entry balance? Right? Yep. And does it? Do the debits equal the credits? Yep. Then you're done.
Missing something.
Pardon me?
You're missing one.
I'm missing one?
Film rentals, refreshments, postage, and printing.
I think are you on the exercise?
No,
It says
I
in the
thought I was on
parentheses to
Quick Study
combine
for.
two.
Oh, I think it says in there on to combine two of them.
oh, okay.
You see what I'm saying?
Yeah.
So, good question. Okay, any questions on that? I know there's a second part here. We're going to go over that in a second. Okay, it says identify the two events from the following that cause a petty cash account to be credited. Now notice here, when we replenish this account, we did not credit petty cash, we credit cash. You can't replenish a petty cash fund with petty cash, okay? So yeah, that is a cash there. So might make yourself a note. But it's saying, okay, well, since we don't credit petty cash when we replenish the fund, when would we? Is there ever a time? And there's two instances, and they're basically the same thing. If you're reducing the amount in the petty cash fund, you would credit petty cash. Or if you are eliminating the petty cash fund, in both those instances you would credit petty cash. And of course, elimination is just being reduced to zero, right? So that's the only time that you would credit petty cash. Cool? All right. Questions on that, folks? Okay. Let's go to exercise 8.6. We're going to do 8.6 first, and then we'll do 8.5. Okay? And again, I'm not going to read through those, but you can take a look at them, folks at home, if you don't have your book with you. But let's go ahead and do exercise 8.6 first. All right? So, let's get that information. Okay, exercise 8.6. Okay, we set up the petty cash fund, right? For how much on exercise 8.6? 200. Petty cash for $200. Is that right? Move that down, you can see it a little bit better. So that's when we establish the fund. Okay, now on January 8th, we have to reimburse or replenish it, right? Now let's go through our steps. The first step, how much cash is in that box when we open it up?
38.
$38, isn't there? So we need to put $162 more dollars. We need to go to the bank and get $162 cash out of our regular account so that we can put it in that metal box and bring it back up to the 200 cash, correct? Now we need to go through those invoices and record the items, okay? So I think we have, do we have postage expense of 74? Okay. What about that $29? Is that what you debited? Yeah. Very good, Frank. Okay. The $29, let's see what the verbiage they use is. Transportation in, right? Now, they kind of trick you here, but you're right, Frank. Good catch. The account that we debit is not an expense account, it's merchandise inventory. Remember when you have transportation charges for a merchandise inventory that you purchase, you debit merchandise inventory. Do you remember that from chapter 5? Good. Most students forget that. And they put like transportation expense or transportation in expense or delivery expense or something, okay? So not the main topic of this, of exercise 8.6, but it's good to remember that. Okay, then I think we had delivery expense, right? For how much? 16. And then I think we had miscellaneous expense for 43, is that correct? Okay, so this was the first step. This was the second step. What's the third step? Ask ourselves if that journal entry balances. Does it? Does it balance? Do the debits equal the credits? Yes, they do. So we don't have to debit or credit any sort of cash over in short account. Okay? All right. Okay, let's take a look at part 3. I think part 3 says, well, what if you need to reimburse the petty cash fund, but you also want to increase it? And you want to increase it to what amount? What do you want to increase it to? I don't think it's 250, is it? Oh. I think you want to increase it by 250 to 450? Yep. Is that what it says? That's right. Yeah, you want to increase it up to 450. Okay. Well, in part 3, you would make this entry again. I'm not going to rewrite it, but that would be again the journal entry to replenish it, and then to bring the account up to a 450 total amount, you would debit petty cash and credit cash for, well, it's at 200, so we have to make this entry for 250 to bring it up to the 450. So in part 3, you have to make both of these entries. Cool? Okay? Yeah, Grant.
You wouldn't credit cash twice, would you? Would you combine them, or would you?
Well, okay, that's a great question. What you're pointing out is we're crediting cash here to replenish the accounts, right? And we're crediting cash here to increase the amount, right? If what you're saying is, can you combine these two journal entries? You can if the net effect is the same. I personally think it's easier to make them as two separate journal entries.
Okay.
Replenish and then increase.
Okay.
You with me?
Mm-hmm.
But if you squish these into one journal entry and if the net effects are all the same, that'd be cool. Okay? I just think it's easier to understand that way. Okay, any questions on exercise 8.6? All right, we have another similar one, which was exercise 8.5. Okay? So let's take a look at that one. Okay. How much do we set up the petty cash fund for? 350, right? So petty cash. This is our entry to establish the petty cash fund, right? Okay, now I want you to pay close attention to this one when we replenish it as far as going through the 3 steps, okay? What's the first step? How much cash is in that box when we open it up? How much cash is in that box? 104. There's $104 in there, right? So how much more cash do we have to put in to bring that 104 back up to 350? 246. Correct? Right? Okay. That's the first step. Second step now is we're going to debit those items as we go through the invoices. So I think we have a situation where we have some transportation in again. Is that correct? Yep. So that was $40. So we debit merchandise inventory because transportation for merchandise inventory gets capitalized to the inventory account, right? Yep. And I think we have some postage expense. And that was for $123. Is that right? Yep. And then we have some miscellaneous expense for $80, is that correct? Yep. Okay. This is the first step. This was the second step. Okay? Now our third step is, does this journal entry balance?
No.
It does not. Which side needs help, debit side or credit side?
Debit.
How much help does the debit side need?
$3.
$3. So what do we debit?
Cash over and short.
Cash over and short. Now I think they actually told us that we had a shortage of $3 here, right? But we could have figured it out if you do this first step, second step, third step method. Okay? Now the reason I am big on the doing those 3 steps and doing them in the order I told you is because here's the mistake students often make. Well, they do this second step first because they know that we want to have the accounts being debited first, right? So what they do is they debit those 3 accounts and then they credit cash for $243 because that's the total of those numbers. You see what I'm saying? That's the common mistake. But that's not right, is it? This is the correct journal entry. But this is best done if you do step 1, step 2, step 3, is there an overage or shortage? Okay? I still mess these up if I try to do those steps in a different order. Okay? And then I think part 3 of exercise 8.5 says they want to increase the petty cash fund to how much?
400.
400. So we have to make the entry for $50. Is that correct? To bring it from 350 up to 400. Grant.
For the account that we use when it's like overage or shortage.
Yeah.
We always write cash over or short. We don't write like cash overage and want if it's debited or cash shortage.
That's a great question. Great question. What he's saying is, do you just say cash? Well, no, we'd say cash shortage there, and if it was credited, cash overage. Are those 2 separate accounts? No, and that's a really good question, Grant. We use just one account. This is one T account. Okay, there's not 2 accounts, there's one. There's times we debit it, there's times we credit it. And it kind of balances each other out, hopefully. Now, usually there's a cash shortage. But no, because it's easier to see what the net cash overage or shortage is if we're putting it all in the same account. So it's kind of a weird deal. If it ends up with a debit balance, then it was a cash shortage, and it will be with the expenses on the income statement. And if it ends up with a net credit balance, it's kind of a revenue account. We put it with the other revenues on the income statement. Usually you're going to have a shortage for reasons we talked about earlier. Yeah, on.
Okay, so I don't know if you explained this earlier, but when you rewrite it, when you're adding money to the petty cash account,
Here?
right? So when you rewrite it, do you just add the cashes that you need together so you don't have it out of place? Because you have to have all your debits first and then your
Are you talking about the second entry or the third entry?
third entry.
Okay. I'm not sure what you're asking. Can you ask again?
Yeah, so when you told us to rewrite for the third step, for that last one, you have to rewrite all of that merchandise, postage.
Okay, well, let me take a look at, because I think 8.5 and 8.6, their verbiage was a little different.
Okay.
So let's take a look at that. On 8.6, part 3, they said they want you to both reimburse the fund and increase it to 450.
Right.
On 8.5, which we just did, part 3 is they just want you to increase the fund.
Okay.
So that was why on 8.6 I showed you on part 3 there were really 2 parts of it.
Okay.
We didn't have to do that on 8.5 part 3.
Okay.
Does that make sense?
Yeah.
Okay. Okay, good questions. All right, anything else on petty cash? Anything else, folks? Okay, now we're going to talk about a really important topic. And we're going to continue on with some internal control topics as they pertain to cash. And what we're going to talk about is the important way that a bank and the different activities that go on a bank can act as strong internal controls. The bank is your friend, okay? There's a lot of things the bank does that helps you in your quest to have strong internal control, okay? They have signature cards. They're supposed to know what your signature looks like so that if you write a check, the correct signature is on there, okay? Not somebody else's. When you make a deposit, they provide you a deposit ticket that you can use as a source document, right? You have a bank account so you can make disbursements using checks that draw on that bank account, okay? They let you transfer funds electronically, and they send you a bank statement, okay? They send you a bank statement. Now, in the old days, we got these once a month, right? Now we still have, they still do monthly bank statements. They usually don't send them to you in the mail anymore. If it's a personal account. Now, if it is a company checking account, they're still going to send you a hard copy of that monthly bank statement. Okay, but now we can check online as well, right? Okay, all right. I want to talk about these bank statements here. Okay, have you guys ever seen a bank statement? You can come off that. How many people here have a checking account at a bank? Okay, most of you. Do you guys still write checks?
Yeah. Never have. I do.
Isn't it funny, Frank? You know, we can talk about the old days when I used to write, my wife and I, when we used to write maybe 20 checks a week. You know, that was how we paid our bills. That was how we did this. That's how we did that, right? We wrote checks all the time. Go to the grocery store, you write a check, right? Mm-hmm. And now, I bet my wife and I bet we don't write 2 checks a week. Because of what?
Online.
Debit cards. Now, we had credit cards long ago, but the debit card, but not just the debit card. What else do we have now? You got the bill pay online, right? Do you guys pay your bills online? That's beautiful. This is beautiful. Frank and I will tell you about the old days. Remember when you used to write checks and you have to walk it out to the mailbox and sometimes you write the date it was due and all that sort of stuff? Now you can just pay it all online, boom. So the people who print checks, I'm sure this has been a sad development for them, right? The other thing that my wife and I don't purchase as much as we used to is stamps, okay? Now, all of these new developments, they're strong, but they do bring up some challenges, some new additional challenges in regards to internal control, okay? But we still are talking about the importance of a bank statement, okay? Now, a bank statement, let's take a look at the screen. This is an example of a bank statement. And now, again, don't think of this, you know, some of this you can think as far as how it relates to you personally. But remember that we're specifically talking about some sort of company. Now, companies still, listen to me, this is important. Companies still do write a lot of checks. They're not making their disbursements with debit cards. And they don't generally use a lot of online bill pay. They're still using checks because of the value of having that source document and the safety that it provides. You with me? But what you have here is, if you can show me on the screen, this is our bank, this is us, we're CloseMart, and they tell us that on May 31st of 14, that is how much cash we have in our account. You with me? Per the bank. And then they show you some different things that happened, you know, check number 108 for 279.50 was written, and we made a couple of deposits here. You've seen this, right? Okay. Now, May 31st, 2014, the bank says this is what we have in our account on that day. If we go to our general ledger or our T account for cash and we look at our May 31st balance, 99.999% of the time, it's going to say a different number than what the bank says. This number and that number are not the same, are they? Now, why are those balances different? Why are those balances different? Why does the balance in our T account at a given date for cash not the same as what the bank statement says our cash balance is on that same day. You guys know this? Why not?
Less health funds.
What?
Less health funds.
There's all sorts of timing differences here. All sorts of timing differences. There's checks that we've written and we've deducted them from our ledger, but the checks haven't made their way through the system yet, so the bank doesn't know about them, right? Or the other thing is you'll look at this bank statement and you'll discover things that the bank obviously knows about because they printed it on your statement, but you don't even know about until you look at the statement, such as maybe you earned some interest, or maybe on the flip side, maybe there's a service charge or something like that. There's timing differences. There's times that the bank knows about things that have happened and we don't know about it, we haven't recorded them until we look at the statement. And there's other times that we know about things and we've recorded them in our journal entries and ledger, but the bank doesn't yet know about them. You with me? So what we have to do is we have to prepare a reconciliation. And let me kind of give you a bird's eye view of what a reconciliation looks like. Okay? Let me switch it over to the document camera. Okay? So what you're going to have is, let's continue on the example that we just looked at on the screen. This is the CloseMart bank rec for, I think they said the date was May 31st of 14. Okay? So what you're going to start out with is you're going to say our cash balance per the bank. And I think our cash balance per the bank was 272592. Okay? And then on this other side, you're going to have the balance per the books or per the GL. And I think that number on the previous screen was 248118. Okay? Those numbers don't equal, do they? So what we're going to have is we're going to have some reconciling items. Okay, on both of these, reconciling items. Okay, so maybe we'll have some that we add. Maybe we'll have some that we subtract or deduct. Again, on both sides, maybe some that we add. Maybe some that we deduct. And then when you calculate your adjusted balance on both sides, you're going to have some number here and some number here, which is, you know, this number plus these reconciling items minus these reconciling items. That gives you a new number. Your balance per books plus these reconciling items less these reconciling items. That gives you a number. And by golly, by gum, a successful reconciliation, these two numbers will equal. And you'll feel really good about yourself. Okay? You with me? Now, it's important to notice that this is not just something that you do, but this is something that you prepare. Okay? Notice I put the name of the company, I dated it and put what it was. And I want to write this out so that if somebody finds my work, they understand that this is a bank rec. It's not a matter of just saying, oh yeah, I did that bank rec. Yeah, I did it. Well, do you have it documented? No, but I did it. Well, that's, even if you did it, you need to document it. Okay, even if you're being truthful and say you did it, no, that's not good enough. You need to have a written bank reconciliation. Okay? Or if you do it on the computer or something like that. Okay? Now, most all of you have a checking account. How many of you do a formal bank reconciliation each month? Raise your hand. I do. Look, there's no hands, is there? I do it. I actually do it on Quicken. That's where we keep our personal finances. And they have a real nice way that you can reconcile your checking account. Okay. Now, I'm going to say one of the most important things that I've said all semester. most people, personally, at least at your age, they don't do a bank reconciliation. But if you are a company, you must do a formal bank reconciliation each month on a timely basis. You must. You must do it because, number one, there are errors that the bank will make that won't be in your favor. And if you're not doing a bank reconciliation, you will not catch those. And number two, the bank reconciliation and the formal process of preparing it is one of the main deterrents of having employees steal from you. Okay? For example, Bob Dew, remember we read about or watched that video on Bob Dew? He was writing himself checks, wasn't he? Who was doing the bank reconciliation?
He was probably.
He was. The bank reconciliation should never be done by the person writing the checks and doing the cash accounting. It should always be done by somebody else. Okay? So, D'Angelo, if you own a business someday and you have some accounting clerks, I'm going to tell you, I encourage you greatly to do the bank reconciliation yourself. Okay? Now, a lot of times, somebody like yourself, they'll start off doing it, and then after a while, they'll just let the other people, they'll let your clerks do it because they're quicker at it, and you don't want to do all that accounting anyway, right? But as soon as you let the person who's writing checks start doing the bank reconciliation, you have totally killed that separation of duties and the independent review. Are you with me? 9 out of 10 of the fraud cases that I've either helped find or heard about, 9 out of 10 of them could have been prevented if the person writing the checks had not been the same one doing the bank rec. Are you with me? You gotta do your own bank rec. Now, you guys don't do a bank rec, and a lot of people say, well, Dave, I don't do a personal bank reconciliation, but don't worry because let me tell you what I do instead. And what is it that they tell me? What do you all do?
Just look at the statement.
Check your statement every day.
You go online and you look for weird stuff, right? Like if you see an expenditure made for $3,200 worth of electronics in the Honduras, well, you're like, well, I don't believe I bought $3,200 worth of electronics in the Honduras last week, right? You're looking for really weird stuff, right? Now, that's good that you look through your online activity, but I want you to understand it is not a substitute for doing a formal bank reconciliation for several reasons. Number one, you can't catch errors of omission by just looking over your stuff. Like let's say that your grandmother gave you a $100 check for your birthday and you deposited it, and it doesn't show up on your online activity because they mistakenly put it in somebody else's account. Well, there's not anything there, right, that's going to jump out as an error. It's an error of omission, correct? Or here's another thing. Let's say you go to Walmart all the time. Well, let's say that, and so you see charges to Walmart, but let's say there's an additional charge to Walmart that wasn't yours. Well, you may not catch that because it doesn't jump out as a weird item. Do you see what I'm saying? If you are a company, you simply must do a formal bank reconciliation. I know I'm preaching on this. Let me tell you, when I go in and consult with a company, the very first thing I do is I say this: can you please bring me the last 6 months of bank reconciliations for all of your accounts, all your cash checking accounts? Because sometimes I'll have like 3 or 4. The only good answer is, yes, I'll be back in about 2 or 3 minutes. Okay? If they tell me, well, no, I haven't done them, we never do them. Or if they say, well, I'm about 7 or 8 months behind. Or if they say, I'll get those to you, but I can't get them to you until next Thursday. This means that our audit engagement is going to be a mess. Because when a company is not doing bank reconciliations on a timely basis, it's bad news. So I'm always curious when I ask that question, are they going to be able to provide these to me? And when they can't, it means we're in for a long, long engagement. You have to do a formal bank reconciliation. And you have to have it prepared and all that so that if somebody like myself comes in and asks for it, you can bring them that. Does this make sense? Okay. All right, let's talk about this. Now, and this is kind of a hard little subtopic to talk about in this setting, because if we were in a face-to-face class, I would have a bunch of whiteboard space and we'd be looking at the screen and you could see a bunch of things at once. And you can't really see more than one thing at a time. So this is a little challenging, okay? But you start off with your balance per bank, you start off with your balance per books, and now let's talk about the different reconciling items that might come up. Okay, there are certain reconciling items that will be on the bank side. Oops, I don't have it switched over. There's certain reconciling items that will be on the bank side. And then there's certain reconciling items will be on the book side, on the right side, okay? Okay, one of the things that we add to the bank statement balance are what we call deposits in transit, or DITs. This is when we make a deposit, maybe late in the day on the last day of the month, so it got into our cash ledger account, but it has not yet had the 2 or 3 days to clear. So it has not yet shown up on the bank statement as of that date. Does this make sense? That's a timing difference. It'll probably show up there in 2 days or so. So that's something that we have to add to the bank statement balance. Something that we have to deduct from the bank statement balance are what we call outstanding checks. What is an outstanding check? You can come off that. An outstanding check is a check that we've written, and think about it, if you're a business, you're writing a lot of checks. 25, 30 a day maybe more. But these are checks that you have written and have gone out there, but they have not made their way through the bank system. The bank doesn't know about them. Maybe they're sitting in a pile somewhere on somebody's desk. Okay? So when you wrote those checks, you deducted your cash balance in your general ledger. But the bank doesn't know about them yet. They haven't made their way to the bank yet, right? So we have to, on our reconciliation, deduct those outstanding checks from the bank balance, because eventually those are going to get deducted when the bank finds out about them. Are you with me? Okay. Those are outstanding checks. Sometimes when a check has gone through the system properly, we say that it's a canceled check. They give you a list of your canceled checks, and those are the checks that you've written and the bank knows about them, they've gone through the system and everything's done. Okay? Sometimes also there will be bank errors. Maybe they charged you for something that they shouldn't have. Maybe they put a deposit in your account that they shouldn't have. Banks make mistakes. Do not think that banks never make mistakes. Okay? I will tell you, I've been doing my bank reconciliation on a personal basis for probably 25 years. And I've kind of kept a mental tally of how many errors I've discovered over the years. I've discovered about 20 errors. Okay? 20 bank errors over the years. So let me ask you this. Of those 20 bank errors that I've discovered over the years, how many do you think hurt me versus how many of those bank errors hurt the bank? 19. They were all errors that hurt me. They were charges that the bank had charged me for that I shouldn't have been charged for, or maybe they didn't give me credit for a deposit. There was never anything like I wrote a check and it never went through the system, or they gave me a big deposit that I didn't deserve. No, they were all errors that hurt me if I would not have discovered them. Okay? So you have to do these bank recs. Okay? Those are all items that are on the bank side of the bank reconciliation. Sometimes I ask myself this. When I have a reconciling item, I said, okay, who already knew about this? Who's just finding out about it? Whichever party is just finding out about it, it's a reconciling item on that side. Now let's talk about reconciling items on the book side. These are the things the bank knows about. It's on the statement, but we're just finding out about. So we have to have it as a reconciling item on the book side. Well, sometimes the bank will make a collection for us. Sometimes banks will provide the service of collecting on a note receivable. And we just find out when we see the statement, oh, good, they collected on this, right? So that's a reconciling items. It's not included in our book balance to begin with. We have to add it. Or sometimes we'll have earned some interest that we don't know about until we get the bank statement. Or sometimes there'll be a bank charge that we don't know about until we get the bank statement. So we have to either add or deduct that, depending on what it is. Sometimes there's a bounced check or a non-sufficient funds check or an NSF check. Do you know what that is? What's an NSF check? What's a bounced check?
I don't have enough money.
Not sufficient funds.
There's not enough money in the account.
Okay, so this is the situation. A customer pays us $200 because they owe us. We make the journal entry and increase cash and deduct or decrease accounts receivable because we assume that that check is going to clear, right? But then the bank statement lets us know, hey, that customer did not have enough money. That check bounced. It was a non-sufficient funds check. So we've already added it to our cash balance when we made the deposit that day. We presumed it was going to clear. But now we have to back out. We have to deduct it. Right? Okay? And then, of course, we can make book errors as well. We can transpose numbers and all sorts of stuff. So let's take a look at an example. And again, this is kind of hard to do in this sort of a setting, but let's do our best. Okay, we're going to start with a bank statement, and we're going to have a bank balance. We're going to have a book balance that we start with. We're going to reconcile those to adjusted balances, and those should be equal when we're all said and done. And if so, we've prepared a successful bank reconciliation. Okay, on July 31st, our company is Simmons Company. The July 31st bank statement says that our July 31 cash balance is $96.10. Well, we look at our T account or our general ledger or our books on that date, and it says we have $7,430. Again, these are different numbers, and that's to be expected. So we're going to do a bank reconciliation. Here are the items that we have to handle. Okay, there's outstanding checks, right? That total $24.17. So what we're going to have to do is we're going to have to deduct that from the bank side. We know about it, we've already recorded them, but the bank doesn't yet know about it, right? So we're going to deduct those from the bank side. Okay? A $500 check mailed to the bank for deposit had not reached the bank at the statement date. So this is what we call a deposit in transit. We're going to add that to the bank side. Are you with me? You'll start to get a feel for which side these go on and whether you add them or subtract them. But think about it. When the bank finds out about that deposit, they're going to add it to our balance, right? Okay. The bank returned a customer's NSF check for $225 received as payment on accounts receivable. So what we're going to do is we're going to have to deduct this from the book side, right? We had added that $225 when we made that deposit because we assumed it was going to clear and it didn't, did it? Okay, so that's a deduction, a reconciling item on the book side that we deduct. The bank statement showed $30 interest earned. Okay, the bank knows about this, but we didn't until now, so we're going to add this to the book side. You with me? Okay, watch this one. Check number 781 for supplies expense. It cleared the bank for $268, but we erroneously or mistakenly recorded it in our books at $240. So this is a book error, and we're going to handle it on the book side of the reconciliation. But how do we handle this? What amount do we add or subtract? And do we add it or subtract it, and how much? $20. Okay. I always have to think of it this way. Okay. We should have reduced our cash amount by $268, but we mistakenly only reduced it by $240. So we've got to reduce it for the other $28. Does this make sense? So this is a deduction. Where's my pointer? This is a deduction on the book side for $28. Okay. And then lastly, point 6, the bank accidentally made a 486 deposit to our account. Shouldn't be in there. That's a bank error. So what we have to do is we have to deduct that out of the bank side. Okay? We have to deduct that out of the bank side. So if you go to the next screen, now they do their bank reconciliation with a top and a bottom. I usually do with the left and a right, but that's fine. So they start off with the bank balance of $96.10. They start off with the book balance of $74.30. They title this thing up so that if somebody finds it, they know what's going on. And then we have these reconciling items, right? I told you about the deposit in transit, the bank error, the outstanding checks. This is added, these are subtracted. Then I told you about the interest that we earned, the recording error that we have to deduct out, the non-sufficient funds check. And then we get an adjusted balance of $72.07 once we're all done, right? And that equals exactly. So what that means is when we're done, we did a bank reconciliation and it balanced. Yay. You with me? That is a formal bank reconciliation. Now I got 2 more minutes here, guys. Don't tune me out yet, okay? Any questions on this? Okay, now we have to do journal entries for part of this bank rec. We only do it for one part of this. Which side do you think we do journal entries for? The bank side or the book side? The book side. We have to make journal entries in our books to account for these reconciling items, okay? So here we have to add $30 to cash for the interest earned. Here we have to deduct $28 for the recording error. And here we have to deduct $225 for that bounced check. So the journal entries that we make are these. Here's where we add it to the cash and we credit interest revenue. Here's where we deduct that $253 from the cash. Well, we have to debit or increase supplies expense for the $28 that we mistakenly shorted it originally, right? And then we have to re-put that accounts receivable amount back on the books. And you think we're going to give that customer a call and let them know that their check bounced? Yeah, we're not very happy with them, right? We make these journal entries as of July 31st, and when we're done and we post those to our account, you can see that our balance equals that adjusted balance per the July 31st bank rec. Are you with me? Okay. All right, you can come off that. I know that's a lot, but you can rewatch this video if you want, or you can always read the textbook. But bank reconciliations are something really important. If you don't remember much from this class, I want you to remember this. You need to be doing your own bank reconciliation, especially if you are a company, okay? You will lose money, okay? All right, any questions? All right, as always, do the homework that is on your homework sheet, and I will see you folks later, okay? Bye-bye.